This thing started. Give me a second. It's being slow. Not even moving. Okay. All right. I think it's going now. Sorry about that. All right. So, this is chapter one in the 25th edition of the Fundamental Accounting Principles book. We're going to go over the PowerPoint presentations. Um, my name is Brian Smith. I'm a professor at South Mountain Community College, Accounting 111 for this course. If at any point I'm going to go through these slides, okay, there's going to be some slides I'm just going to skip over, maybe just gloss over really quick. That doesn't mean that you're not necessarily responsible for it. There may be a couple of things I say, don't worry about it, and that's fine. But still, if I bring it up or if there's something that interests you, please feel free to contact me and let me know. Okay, so with that, let me see if I can get this little bar to go away. And let's do that. All right. So these are the learning objectives. Bottom line is by the end of this chapter, and as you study through it, you should be able to understand these concepts, be able to identify and analyze things, and do the procedural things. So bottom line is just trust me, we'll take you there. Okay. All right. So you're in Accounting 111. So you're probably saying, why do I need to take this course? Why accounting? This thing's boring. Okay. First of all, I love accounting. It's not boring to me. I'm excited for it. And I hope you learn what is exciting about it. Okay. But here's the importance of accounting. Okay. Accounting measures, well, first it identifies, it records, and it communicates. Okay. All the financial information that we get, we identify whether or not the financial transaction has taken place. And if so, we record it. And the ultimate goal is to be able to report it or to communicate this to other people. And those people could be internal to the company, they could be external to the company. And we'll get into the users here in a second. As a result, accountants are absolutely crucial. And no matter what company you are a part of, at some point, whether they've outsourced it or not, they need accountants to do the work. So, users of information, who are we making this information for? We have external, we have internal users. The first one, let's talk about external users. External users are going to be people like shareholders, lenders, non-managerial employees. That's kind of an interesting one. You can be an employee of a company, but if you're not a manager or higher, then you're considered an external because you really don't have access to that data. For example, I used to work at a manufacturing plant and I was on the line manufacturing items. I didn't know anything was going on with the sales or anything else, stuff like that, or the production and things, but managers did. And so I was considered a external entity because if I were to ask for data, all I'd get is the financial statements or whatever was provided to other external entities. External auditors and regulators, all these are considered external users. And for the sake of this course, Accounting 111, we are focusing solely on external account or users. Okay. Internal users focus on more managerial information, and you'll get that information in Accounting 212. So just know that that's going to happen there. Internal users include purchasing managers, HR managers. Yeah, notice on this list that most of them are called managers. Okay. Other internal users might be internal auditors or the CFOs, executives, controllers, things like that. So a lot of information that the internal users have access to, whereas the external users do not. This slide here is kind of as an introduction. I know a lot of you might be accounting majors, hopefully. If you're not, if you're just a general business or whatever, this slide is to help you realize how important accounting is and the career opportunities you have in there. So right now I have things I've done. I've done financial analysis, external auditing. I was in regulatory, criminal investigation. I did do a whole lot of managerial. I have done taxation, planning, and preparing mostly, and then other accounting related fields. Let's see if I've done any of these. I've analysis, same thing. No, none of that. But forensic accounting, I've done that. So that was part of the criminal investigation, accounting, fraud, and stuff like that. So I've done a handful of a lot of things in each one of these areas. So it's a very exciting field that you can bounce around in and do whatever you want in here. So please don't limit yourself. If you're wanting to be a manager, or if you're wanting to be like some kind of CEO or whatever, man, accounting is your goal because you can move yourself up real fast in this managerial area, okay? And understanding the accounting is definitely going to help you. So if you're not sure, really give accounting a hard look. And if you are, let me know. I'd love to happy to chat with you about it. All right. So artificial intelligence, okay, this is kind of one of those interesting slides. It uses software to compute stuff or to do repetitive tasks. Like for example, let me get a drink here. And also before I go on, and in all future videos, if I yawn a lot, it's because I have this breathing condition where I don't get a lot of oxygen. And so sometimes I'll yawn. It's not that I'm tired or bored. It's just that I all of a sudden my body's like, breathe, Brian. Okay, so when I was a fraud investigator, we had to take financial statement data and translate it over to Excel so we can analyze it. It was a very tedious task, and we ended up coming up with a way using artificial intelligence to read the financial statements and then translate it over. It was really effective, helped us out a lot, and made things go a lot faster. Um, and this is kind of just a thing to kind of help. Data analysis is very crucial to the accounting field. So if you're one of those people that say, "Man, I could I could just look at numbers and analyze it all day long or write code or whatever," I mean, this is still an area that if you can find ways to improve accounting information systems, and there is a lot of opportunity to do that, you will be in high demand. Okay, so just know that this is another area that can be used. All right, so with that kind of precursor, now let's talk about some of the we're gonna in this course we're gonna talk in the beginning very basic things. We're gonna talk about how and why we do accounting, and we're gonna build from there. The first thing though is to be able to establish that we have ethics. Okay, ethics is crucial, and here's why. You can take a rule or a stated situation and you can manipulate it. You can make it to where you will do whatever it is you want, okay, and have a good argument for it. The question is, though, is it ethical? Is it really following the purpose as to why that situation was instated? So, in this example, like right now, we have an ethical concern. This person's staring at a glob of money. What should he do? Should he put it in his pocket or put it in the safe and deposit it? Okay. Analyze all the options. Consider all the consequences. If I take the money, I could go to prison. Or if I put it in the safe and deposit it, I'll still have my job. And then make your ethical decision. All right, I'm going to go make the deposit. And then they give the deposit slip there. Stuff like that. It sounds really easy and stupid me putting it that way, but let me tell you, when I was a fraud investigator, I put away a lot of people who should be celebrating their anniversaries or their grandchildren and things like that instead of doing time in prison. So, it could be anybody. So, and with that, let's talk about the fraud triangle. Okay, these ethical decisions sometimes allows people the opportunity to commit fraud. The difference between an error and a fraud is that error is something that's done accidentally, whereas fraud, there's intent behind it. For fraud to exist, there usually needs to be at least three of these situations: an opportunity, the rationalization, and the pressure. Now, there are some things and I always say this, there is a possibility that pressure doesn't exist. There are some people who can just do it and they do it just because there's no pressure, there's no reason to rhyme. It's not very often, but it is it's not it doesn't mean that there's pressure, but there has to be opportunity. There has to be some kind of workaround or something in the controls of the company that allows that person to do something out of the ordinary and without getting caught. And the rationalization, a lot of time people and the people I investigated were like, well, I did so much. There was this guy up in, well, I shouldn't say where. Anyway, he was a school teacher who started a club and then started a catering business with this club. And they were supposed to get the money through this catering business. He started siphoning off money into his own personal accounts. His rationalization was, I put in so much time and effort. I mean, this is my money. I put in this extra work. But he was getting paid by the school to do the extra work. It just wasn't as much as he felt he should. So anyway, he got in trouble, and that was an interesting case. But the pressure is there a lot of times because people don't have enough money. They have to pay their unpaid bills. There's but sometimes the pressure is that they put it on themselves in the sense that there was one lady who was just a spendaholic. She stole $1.8 million dollars, and she just spent. I mean, I don't think she had a dime to show for it after all that was said and done. But anyway, opportunity rationalization pressure, very interesting things. If you're interested in fraud, come talk to me too. We do have a fraud class that we teach in the spring, and I'd love to have you be a part of that. So come chat with me. Okay. So, in order for us to be able to have information that, according to the site, is relevant and that we can faithfully represent what's accurately going on with our business, we have to establish things called generally accepted accounting principles. We call this GAAP. These are basically accounting principles that we say, hey, these are generally accepted among all people in the United States, that this is how we do accounting, okay? And this is what we do. And what this does is it helps it to where if you get two financial statements from two different companies, because of generally accepted accounting principles, we can compare them and be able to analyze them. Instead, if we didn't have these, somebody could be giving me it in one form, the other person could give it to me in another form, and I can't compare them. So it's kind of a very good thing for us to be able to have. Excuse me. Okay, the Financial Accounting Standards Board, or as we call it, FASB, they're the ones that set GAAP. They're a private company that is authorized by the Security and Exchange Commission to do this. So they are the SEC is the one that oversees it, and they oversee all companies that are traded on the stock exchange or sell debt to the public. So these things are how it wasn't always this way. We used to have Sarbanes-Oxley, or before Sarbanes-Oxley Act, and don't worry about this act, just know that it exists. FASB just did it, but then when that happened, the financial meltdown of 2000, you can't remember now, 5 or 4, the Sarbanes-Oxley Act was enacted to prevent the accounting industry from screwing up the way we did in a major way. I was still in college at the time, so I was not one of those people that screwed up. So. Just know that there are international standards. I am not going through IFRS. I will not be comparing IFRS to GAAP. I will not be doing anything related to IFRS. I do not believe it is appropriate to teach in an entry-level course. Just know that what the United States does and what pretty much everybody else in the world does are two different things. IFRS doesn't provide very strict standards. They give more of the principles-based as opposed to rules-based that GAAP is. But you will not be tested. I will not ask you a question or anything on IFRS or the International Accounting Standards Board. I do not even like it. I don't even like the fact, unless you go to a multinational company, you'll never deal with it. And I've took 2 classes on that, and I still hate it. So just my personal flavor. Everyone likes ice cream, right? Some people like that stuff with the balls that go into the, tapioca and stuff, and I just like straight chocolate or, whatever else. So, okay. So here's your conceptual framework. I'm not going to go into the very specifics about this, but as you go through this course and Accounting 112, you will see how everything we talk about kind of ties into all of this information. But just be familiar with this, okay, this concepts and everything and how it works there. These are ones you're going to want to know. Principles, assumptions, and constraints, okay? Principles are basically what we use to guide us in our accounting and how we account for certain transactions. Assumptions are assumptions that we make because we have to in order to be effective at our accounting. And constraints are specific rules or things that we constrain ourselves on that we don't go overboard with. And I think you'll understand it here in a minute. Let's first talk about the principles. We have 4 principles, and the first one is the measurement principle. So this principle says that whatever cost we have for this particular asset is what it is. If I spend $100,000 on a piece of property, I'm going to have it. It was $100,000 I'm putting in there. I don't care if it's worth more or not. It's not going to go. We're not putting it on fair market value when we record it. It's what it cost us. Okay. There's some minor exceptions that you'll learn later on in Accounting 112. But in Accounting 111, whatever it cost us is what we recorded at, okay? The revenue recognition principle. Unlike what you're used to, all right? When you work for some person, you work, and you don't get any money or revenue until they give you the cash, right? We call this the cash basis of accounting. That's not what we do in accounting. We're going to recognize that revenue. If you've worked, and you're done working, and then you say, hey, you owe me money, and he says, I'll pay you next week. You recognize that revenue today. not next week when you receive the cash. Okay. Revenue recognition means we recognize the revenue when we have provided the goods or the services to our customers, and we expect to receive that money from them. Hopefully, you're not going to do the work or provide goods to somebody and you're not going to expect the money, but at some point it could be that's the case, and we'll go over that in chapter 9. Now, the expense recognition principle is very similar to revenue. It's just on the expense side. And we are going to expense our costs in the accounting period we used them, not when we paid for them. It might be that we did pay them, but we're going to record them as we use them. For a good example is your utility bill. If you pay utilities, you get the bill and it says how much you used last month. Well, if you're doing it just what you normally do, well, my expense for the electric bill today was $250. So I paid $250 today in May, and that's my May expense. But in accounting, that May invoice was for April. So my $250 I paid today was for April. We're going to record it in April. So we're going to post date it or backdate it to April 30th and say that's when it was. And that's just a date example. If you're viewing this in the summer or in the fall or spring, your dates might be off. Don't worry about it, but just you get the idea of the date transition. And then the last principle that we're going to talk about is the full disclosure principle. We have to disclose anything that is important and relevant to what our decision makers are going to need to know. So, for example, if I have a $100,000, I'm stuck on $100,000. Let me up that a bit. If I have a $100,000 lawsuit against me and I think I'm going to lose, I got to disclose that no matter how bad it makes me look. Okay. But if I'm a $1 billion company and I have a guy that I found out just stole $500 out of the petty cash fund, yeah, under the full disclosure principle, yeah, I got to still report that $500. But as you're going to learn in our constraints, there's a materiality constraint that says because it's so low an amount, it really isn't going to influence any user's decisions. We don't have to. But full disclosure, if anything happens that would impact the user's decisions, they must be reported and they must provide that data. Now, here's some assumptions. Okay, we've got 4 of these as well. The going concern assumption. This is like the only assumption that really kind of doesn't make any sense why they call it this. But you'll be tested on it. You'll have it. This will hit you. But the going concern assumption is basically you assume that this company is going to be going forward in its current state without being sold or closed or bankrupted or anything else for the foreseeable future. Okay? You assume that there's not going to be any concern about this business to continue operations. It's going to keep going on as it goes on. Because if we assume it is, or we don't have that assumption, then there's a problem there. In fact, as an auditor, if that's something you end up wanting to do, you will look at a company and you will ascertain what business they're in and whether or not there is a going concern assumption. So let's say this one's a good one. Let's say you're in the business of making those old floppy disks, those square ones. I don't know if you even know what those are, but maybe you don't. There's these old disks that you'd put into your computer. I mean, I think they had a whopping they had like 56 kilobytes of memory. They did not have a meg. They didn't even have 1 megabyte of. I remember when megabyte stuff came out and we were like, whoa, that's how old I am. Oops, I clicked the button. Sorry. Oops, twice. What did I do? Oh no. I went back all the way to the front. This is not what I wanted. I hit my keyboard and it must have sent me home. Let me try and get back to where I was at. Anyway, I'm kind of rambling on, but anyway, going concern. If I had that company of selling those and that's all I sold and I still sell them and someone's auditing me, they're gonna be like, yeah, you're probably not gonna be in business very much longer. Okay. And they're surprised that I even lasted as long as I did. So that's what that means. Monetary unit assumption. It means that we assume that we're going to report our information in money. Okay. And we're going to be consistent with that. So for example, if you are a Canadian company and you're providing your financial data, you better pick between the US dollar or the Canadian dollar, because if you present it in a mixed format, you're in trouble. And if you do, if you do put it in US dollar, you need to do the proper translating it over to the correct US dollar amounts, because there is that foreign exchange of the currency that you need to take in effect of. So basically our monetary unit assumption is we assume that all the events and transactions are money or units It's not going to be the value of pigs or something. I'm just trying to think of what it might be, but basically that's kind of what it is. The time period assumption is that we assume that we can divide this company's time period into usable time periods. We tend to steal. No, I'm a fraudster. Um, Deal with months, quarters, and years. All right. We could also look at it biannually, or excuse me, semi-annually, or we could look at it as an 18-month time window. Those are typically not common. It's usually months, quarters, and years. So, but those are the possibilities. You don't see too many things dealt with on the weekly or daily basis. That would be a lot of extra work. Could you imagine doing a financial statements for every day of work? That would be asinine. That would be tough. And the last one's the business entity assumption. We are going to assume that this business and all the transactions provided is only this business. It does not include the owner's personal finances. It doesn't include any other of the owner's businesses. Haven't commingled these assets. Haven't commingled any of the information. It's all one entity. Okay, that's what we assume there. All right, and then they throw this slide. Honestly, the slides that the company puts out, I should spend some time to kind of clean them up maybe. But then they throw this in here, guys. We're going to talk about this in Accounting 112. I don't know why they do that. Here are some constraints. Now, this is what we want to talk about with constraints. Cost benefit constraint. Okay, if you have a constraint a situation where you could be more effective at presenting or fully disclosing information, and it would be greater benefit to the people who are looking at that financial data, but it would cost you so much more money to do it, then you don't need to do it. Okay. For example, when we get into chapter 6, we're going to be talking about inventory systems. And one of them is where it basically updates all the time. Okay. That's like your big box companies, your Walmarts, your Targets, and things like that. And then you have this other one that kind of only occasionally updates, all right, every month or something like that. That's your smaller companies, your mom and pop businesses and things like that. Now, if a mom and pop business is doing about $100,000 in revenue a year, and it's going to cost them about $500,000 to implement a constantly updating inventory system, it would give them more relevant information. It would help provide more data and in a timely manner, but the cost outweighs significantly the benefit that would be derived by that company. So we don't have to do it in that situation. So we have to make sure that the benefit's better than what the cost is going to be. And if it is, then we would want to include it. The materiality constraints, similar to what I talked about earlier in the full disclosure principle. When we have a materiality issue, if somebody steals of $1 billion company, we're talking like Microsoft, Apple, these big companies, and someone stole $500 from the petty cash fund, nobody in their right mind in the investing world cares. Okay, the company hopefully cares, and they're going to discipline that employee and maybe terminate them or something. But if someone stole $500 out of the petty cash fund, it was caught. It was no big deal. There's no need to bring that up. Okay, it's just one of those things that kind of happens. If it doesn't impact the financial statements in a meaningful way, and you don't have to disclose it. And as you become an accountant and learn these things, you'll know what meaningful really means. And then the last one is conservatism and industry practices. This is basically saying, hey, don't take risky positions with your financial stuff. If you feel like it's more conservative to say, well, it's more like this than really that, which is what I really want it to be, stick with the conservative approach and follow industry practices, which may also restrict or do other things that would, like, for example, if an industry doesn't typically issue any kind of statements on certain transactions because of confidentiality or anything, then obviously you would omit that. So that's kind of what we're talking about there. All right. So now that we kind of have the standards, the basis or the foundation laid, I know most of you thought this was only a numbers class. So far, it hasn't even been one. But now we're going to jump into that. We're going to define and interpret the accounting equation in each of its components, all right? We have three main components of the accounting equation: assets, liabilities, and equity. We'll get into what assets, liabilities, and equity are later. But for right now, take my word for it that for all the assets a company has, that will equal the total liabilities plus the equity, okay? Now, if we expand this equation, all right Right now, it kind of doesn't really show it. We're just expanding this equity section right here. This equity section is going to be owner's capital minus owner's withdrawals plus revenues minus expenses. And revenues minus expenses equals net income, okay? So that's our expanded equation. We're going to deal with this expanded equation at length in this course. So you'll want to make sure you understand that expanded equation. As it was when I said at the beginning of this lecture or this discussion, it's more of a lecture because, I'm recording it, so I guess we're not discussing anything. We are going to analyze each transaction. We're going to identify it. We're going to analyze what it does and how it impacts it, and then we're going to report it, okay? So let's talk about the analyzing these transactions now, okay? So first of all, let's say we're going to start this company up, right? The owner's going to invest some money into it. In this case, it's $30,000. Business name's going to be called Fast Forward. It's a company that's going to deal with fast forwarding videos for you. I don't know, fast forward, whatever. Okay, so when we do this, when we say the person is Chaz Taylor, all right, they invest $30,000 cash in this new business. What accounts? First thing we want to do is what accounts are going to be involved here? Well, Chaz Taylor is going to be an equity account. It's the equity that the owner has in the company that if they were to close today would be left over for that owner to take out after liabilities have been paid. But if this is the very first transaction, we have no liabilities. All we have is this $30,000 cash that got put in there by Chaz. So we're going to have cash, which is an asset, and we have the Taylor capital, which is an equity account. And they're both increasing. So we have an asset going up by $30,000 and an equity going up by $30,000. So let's look at the accounting equation. In fact, $30,000 in assets, $30,000 in equity, 30,000 equals 30,000. All right. Now here's the second question, or second transaction. The company purchased supplies paying $2,500 in cash. What accounts are being impacted? First, cash again, but cash is going down because we're paying it out. But supplies is not an expense. It is an asset, okay? Supplies are an asset until we use them. So we buy supplies, and that is an asset, and it's going to increase. So we look at our accounting equation. Let's look at it all from the asset side because only assets are being impacted. Our asset in cash is declining, and our supplies asset is increasing. So we still have $30,000 of assets equals $30,000 of liabilities plus equity. We just changed the components of what the assets are. We got rid of $2,500 worth of cash and changed it to $2,500 worth of supplies. Yeah, still in balance. And they're circling them. Okay, come on. All right. I've done this. This is about the 5th time I think I've made this video too, and I always forget how they do that. It's pretty funny. Anyway, purchase equipment for cash. All right, so now we're purchasing equipment for cash. Equipment is something big. Maybe it's a car. Maybe it's some kind of machine that's going to do something, whatever. It's equipment. We're paying cash. Equipment is also an asset. So is cash, as we've already established. Cash will decline, and equipment will increase. We're doing the same thing, okay? Cash goes down, equipment goes up. Now we're at $1,500 cash. Whoops, we're kind of low on cash. That might not be a good thing. But we're still in balance, and that's a great thing. Purchase supplies on credit. Okay, when it says on credit, you can think credit card if you want, all right? It's you're buying credit because you're going to pay it later. So how much are we buying? $7,100 worth of supplies. So we're going to have assets, which is supplies, is going up. And this time we have accounts payable, which is a liability, and it's also going up. So let's check out our accounting equation. So now we've increased both sides by $7,100 because our liabilities went up, but so did our assets. Worst case scenario, that $7,100 of supplies, if we were to close shop, we just give it back to the company. The owner takes out the equipment and the supplies they bought with cash in the $1,500. So basically, the equity still is $30,000. We're in balance at $37,100 for each of those areas. See how we're looking at each time after a transaction, we're still checking to make sure that our accounting equation is in balance. It's very important that we stay in balance, okay? Very important. We are providing services for cash. Let's look at this. Fast Forward is now providing consulting services to a customer, and we already received $4,200. Keyword here is provided, means past tense, which means we did the work and now we're getting the cash. So we're going to have cash and we're going to have revenue or consulting revenue as our, it just says revenues, okay, our accounts. They're both increasing. Cash is increasing, we're getting money, and so is our revenues. We're recording that we did this work and that we have either received or are entitled to receive that money. Here's our accounting equation as it is impacted by that $4,200. You see now the balance of each of the other accounts, so we're going on pretty good. All right, payment of expenses in cash. So now we're going to pay rent of $1,000 and salaries of $700 to our employees. This is two expenses that we're going to record in the same transaction. It's called a compound journal entry or transaction. So we're going to decrease cash because we're paying both of these in cash. We're going to increase salaries and rent expense. Now, because these are expenses, if you'll remember from the accounting equation, we're going to calculate our equity, we take our owner's contributions minus owner's withdrawals plus revenues minus expenses. So by increasing the expense, you're going to decrease overall equity. Think of it this way. If you have $10 and you subtract 0, it's $10. But if you subtract 5, which is an expense, you have $5 worth of expenses. Now you have $10 minus 5 equals $5 left over. So our expenses, as they increase, will decrease our overall equity. So with that, and this is your reminder that exactly what I just told you, make sure you understand that the expenses will reduce that equity. So we're showing it over here. Those parentheses represent a decrease, okay? And it's showing that the expense result in this accounting equation is a reduction to overall equity. But when you put these in as expenses, you would put them in positively, and then they would decline the overall equity, okay? But in this case, we don't show the formulas. We're just showing what equity is and what the impact on the accounting equation is. So we're showing you there that they are, in fact, negative or a decline. So that's what those parentheses do, is they decrease it. All right. Now we provide services and facilities for credit. In other words, we are doing some work and we are renting something of our business, of our facilities or whatever, for money. So just like we have rent expense, now we're going to have rent revenue, and we're going to receive consulting revenue. So we'll have two different revenues we're going to deal with. First of all, if it's on credit, they haven't paid us the money yet. So we're going to have what's called an asset called accounts receivable. Our customers owe us money to the tune of $1,900, okay? Consulting revenue and rental revenue are both, they're all increasing. And so since it was $1,600 and $300, we're going to see an increase in our accounts receivable by $1,900. And we're going to see an increase in revenues by the same amount, but two different types of revenue. But look at the accounting equation, we are still in balance. Receipt from cash from accounts receivable. Now the people owe us this money, and later on down the road, after a few days, we got it paid back, okay? Or they paid it to us. So from the last transaction, they decided to pay us that $1,900. We don't re-put anything about revenue. We're simply saying, hey, we had this, basically, they owe us an IOU from them. We're going to go ahead and take this down to 0 and put our cash up by the amount of that IOU because they paid it off. So we're going to decrease our account receivable and increase our cash. So with this, let's go ahead and look at our accounting equation. Our $1,900 in cash is going up, and our $1,900 in accounts receivable goes down to 0 because they paid it off. We are good to go. Our accounting equation was not impacted because we just changed a form of asset to another form of asset. Okay, now when we want to pay some money on our accounts payable, okay, we owe, I think it was about $2,500 or something like that. We're only going to pay $900 of it, okay? All right, let's go ahead and look at this. Cash, we're going to go down. Our accounts payable, which is the liability, is going to go down as well. So we're going to decrease both sides of the accounting equation. So let's look at C. $900. Oh, we owed $7,100. Whoops. All right, so a little bit more than I thought. So anyway, we're decreasing by $900. So we're going to decrease the cash by $900, decrease the accounts payable by $900. We're still in balance. We're in business. And the last transaction, let's say an owner withdraw the cash withdrew the cash. The owner withdrew cash from the company. I can talk. Oh, they're going big. They're going $200. They're going to go to Vegas, turn that into $20 million. So we're going to decrease cash and we're going to increase withdrawals account. But by increasing the withdrawals account, it will be a decrease overall to equity. Okay, same thing as the expenses, same concept. As you pull more money out, it's going to decrease overall equity, but you're recording that you took it out, so it's going to increase that withdrawals, but it'll be a reduction to equity overall. So we go over here, we see a reduction to cash, and we see again that it's annotated in the withdrawals account as a subtraction, when in reality, the account itself is increasing, but to reflect what it does to equity, it's showing it as a reduction, which is not untrue. Okay? All right, so here's the summary of transactions. You can pause this and look at them as you want. Go over them, kind of understand it. This is the bread and butter of what you want to focus on and everything. If you have any questions, these are important, very important. This stuff is what we build on for the rest of all the accounting classes you'll ever take. Got to know the accounting equation. And then the last thing we're going to talk about today is the preparing of the financial statements and how they interrelate, okay? Basically, our net income is calculated revenues minus expenses, and this is demonstrated on the income statement. Statement of owner's equity is your beginning capital balance, if any. A lot of times in this course, we're going to start off at zero because the company just started. We're going to add any of the owner's investments and the net income we calculated from net income from the income statement. Can't make the statement of owner's equity until we've made the income statement. And then we're going to subtract out withdrawals, and that's going to be our ending balance in our capital account. Then we're going to take the balance sheet, and we're going to show all of our assets, and we're going to show all of our liabilities, and then we're going to take that equity amount we had here at the end of ending capital balance from the statement of owner's equity and put that there as our equity, add our liabilities and equity up, and compare them to our assets, and they better equal, otherwise we did something wrong. Statement of cash flows is going to show you differences and changes between operating, investing, and financing activities, and it's basically going to show the change in your cash account. We're not doing that in Accounting 111. We'll do that in Accounting 112. It's a pretty, I don't want to say difficult statement. It takes you some experience to be able to put that together, but it's very doable, and I love cash flow statements. They're fun. Here's an example of what we just did. All of our consulting revenues were added. Our rental revenue, we had total revenues of $6,100. We had our expenses. We subtract those out. That's our net income. Then our statement of owner's equity, we show that we had a zero balance at the beginning because we just started the company. We show the $30,000 that the owner invested, added net income, and then subtracted out the withdrawals. Then we take that and we put it over in the equity section on the balance sheet, and then we just list everything else. Our cash, supplies, equipment as assets, and then accounts payable as our liabilities, add the liabilities and the equity together, and we equal $40,400 on both sides. Remember, our accounting equation was in balance the whole time. That ending balance that we had is reflected on the balance sheet, $40,400 on both sides. And then here's the statement of cash flows. Again, you want to look at it, you're welcome to, but I'm not going to go over that. If you're interested, you will be doing a lot of this in Accounting 112. Not a lot, just we do a little bit of a project that we do some calculations, but return on assets is basically a way for a company to assess how much money they're getting based on their assets, and this is the formula. I believe I have some quiz questions that could be pulled on this, but it's basically there for you to kind of know how to do that. But I'm not going to be. I don't think there's anything on the exams on this, and I'm not going to be. Can't remember if I'm assigning homework on there or not, but bottom line is just know it. But I don't believe I'm holding you to it a whole lot in this class. It'll be in Accounting 112. We'll get to know it a little bit better. So, all right, that's Chapter 1. Hey, thank you guys. We'll see you in Chapter 2. Good luck in Chapter 1. If you have any questions, as always, please contact me as soon as possible. The sooner the better, because if you're struggling with Chapter 1, you're going to struggle with Chapter 2, and I don't want that. So please, whatever questions you might have, ask them now, and I will be able to help you out. So with that, you guys have a good one, and again, we'll see you in Chapter 2. Oh, before I go, let me give you a word so that you can put it on the quiz site so that it shows that you watched the video. So our word today will be evaluation. EVALUATION. Evaluation is your word. EVALUATION. All right. See you in chapter 2.